US regulators are studying cracking down on psychological prompts used by commission-free stockbroking apps. It comes after rookie investors drove stocks, including GameStop, to record highs last year. Howard Fisher is a partner at the law firm Moses and Singer. Our correspondent Juliette Mann spoke to him about the trading frenzy and the fallout.
What happened was a very unusual circumstance where you had a general consensus in the investment community that certain stocks were due to decrease significantly in value. For some strange reason, a group of traders and people who followed various Reddit chat boards agreed that this was some kind of plot by short sellers to destroy the stocks and the companies they loved. So they ganged up together and agreed to buy companies like AMC or GameStop. As a result, the price went from $4 or $5 a share to several $100s a share, even though the companies had very poor prospects. It was an unusual frenzy, and it made regulators very upset and concerned about what this could mean.
But the commission-free brokers say they're democratising investing, making it easy to learn the basics with new tech, AI, gaming-style tools. Or is that just a marketing ruse to hook young investors?
What you have seen is, in some sense, a democratization of the investment world. You've had well over 1 million investors between the ages of 18 and 21 join the markets. These are people who in America can't legally take a drink, yet they could trade away their entire life savings. And what a lot of them don't fully understand is, one, that what goes up could go down, and two, that the people who are providing the trading platform might not necessarily have their best interests at heart.
So let's talk about what the potential consequences could be. I mean, what effect could the SEC investigation have on digital engagement practices? I mean, are we looking at game-changing compliance burdens?
What I can see the SEC putting into effect are several potential changes. One is that they could regulate fewer kinds of push activity. And the problem is that there are these bolts of serotonin and adrenaline jolts that you get when you engage in trading on some of these platforms. The famous one is the famous confetti spur you get when you buy or sell shares of a stock. I could see the SEC limiting or even eliminating that completely, and that raises another issue, and that is the content of a user interface itself a form of provision of investor advice? And these are very complicated legal and technical issues, and I'm not so sure that the SEC or European regulators are fully able to figure out psychologically what kind of interfaces are the kinds that promote reckless trading and which are harmless.
Digital investing, it has that air of the Wild West, and I'm wondering if these retrospective moves to regulate are going to be enough, or if the horse has already bolted.
Regulators are always approaching the last issue. And online trading has significantly decreased from the era of the GameStop frenzy. So maybe the behavior of people during this GameStop and meme stock frenzy was just a fad. Some people have proposed what's been referred to as the boredom hypothesis, which is that in a lockdown, especially one where sports have been limited and you have fewer opportunities to bet on sports, people are bored. They look for amusement, so they go to trading. They did that for a year or so. On to the next thing, on to the next TikTok dance phase. So, it may be the case that the phase has burnt itself out, and maybe there is no need for regulation. I don't think the SEC sees it that way. I don't think other regulators see it that way, but that's always a possibility.